Good morning, everyone, and welcome to our series Fintech Fridays, brought to you by Video Australia and the 2022 Intersekt Festival, which is on next week in Melbourne. In our webinar today, we'll be discussing the Australian blockchain ecosystem, Web3, and the current state of cryptocurrency. My name is Tim Aman. I'm Video's global Fintech leader, as well as our national financial services leader. Before we kick things off, I'd like to quickly draw your attention to the housekeeping slide that is currently showing on your screen. To start, you are all automatically muted, but we'll be accepting questions throughout the session, and you can submit these using the question tab. We'll try to get to as many questions as possible. However, if we cannot respond to your question, we'll follow up with you after the webinar concludes. If you're experiencing any technical difficulties, please click the support button, which is one of the bottom tabs on your screen. And finally, this session is being recorded, and all registrants will receive a follow-up email confirming the slides, a link to the recording, access to register for future sessions, and the speaker contact details for all of us. Blockchain is a changing future of finance with a model that looks to remove the middleman, strengthen transparency, and streamline transactions. It's an exciting time to be part of the fintech space as the financial markets continue to decentralize and the blockchain ecosystem in Australia and Asia Pacific develops. On the slide here, you can see just the Australia ecosystem. And Michael probably will refer to some of this when he has a chance to talk. But you can see it's alive and kicking. And Glenn will be able to give a bit of an overview of what's happening in Asia Pacific. With me today is Michael Bacina. He's been on before, so welcome back, Michael. Michael is a partner in digital law at Piper Alderman. Michael provides expert legal advice and guidance to clients in relation to commercial contracts, corporate law, fundraising, compliance, particularly those with a technology focus and blockchain deployment. I'm also pleased to welcome Glenn Wu, head of APAC sales at Blockdaemon. Glenn oversees business strategy and sales across Asia for Blockdaemon, which offers institutional-grade blockchain infrastructures connecting businesses to blockchains. Welcome both of you, and welcome to Fintech Friday.
Thanks for having me.
So first, we'll talk a little bit about the blockchain ecosystem. Blockchain is largely associated with Bitcoin and cryptocurrency, and we'll talk about those a little bit later, but first I'd like to talk about blockchain as a whole. Glenn, first I'll start with you. Thanks for joining. I know you've flown back to Korea. You're back in your childhood. I know that those books are about kids. You're not in your childhood room, but thank you for joining after the long flight. Despite the potential of blockchain, from improving business processes to aiding in supply chain, there's still a lot of uncertainty around the adoption of the technology. And I guess one of the biggest questions around blockchain is whether it can work at scale and remain decentralized while maintaining confidentiality. Do you think, what's your view in terms of blockchain and being able to meet all of those different requirements?
Right. Okay. First of all, thanks for having me. If you are referring to the blockchain's trilemma, like those three factors that, in an ideal world, blockchain would want to achieve, that would be security, scalability, and decentralization. And, like this has been an ongoing topic, like, ever since, I can remember. Maybe, I've been in the industry for about 5 years, and, it was a big debate back then as well. But, the space has moved on, and we have multiple blockchains now. Us at Blockdaemon, as an infrastructure, institutional infrastructure company, we already support more than 60 layer 1 blockchains from a node perspective. And there would be a lot more that's out there. And we're talking to these new folks that are building their own layer 1, layer 2 bridges with their own consensus ecosystem. These communities are all tackling this problem. I think more so from the angle of what they want to build. So before, when a lot of people used to talk about, let's be the computer for all, like the likes of Ethereum. But now, you talk to some of the gaming folks, you talk to some of the payment folks, and they could be building their own blockchain, maybe sacrificing, one of the three, right? But they're fine with it. And, people these days refer them as app chains or fit for purpose blockchains. And, with the mindset of really, catering towards what is really needed from a wide adoption perspective, just narrowing down on what they've experienced with their customers. They're happy to make that sacrifice. And, there's always kind of like a fallback option. And, this is what Ethereum communities actually talk a lot, is that, okay, like all of the other Ethereum competitors, they could provide, they could be less of those three pillars, but you can always fall back to Ethereum for the, for the bigger ledger, because Ethereum is, decentralized, is very secure. It may not be as fast from a scalability perspective, but we have some good examples these days, like Ethereum 2.0, sharding and rollups, and Polkadot with this parachain ecosystem, where the actual ledger bookkeeping goes back to the main chain, whereas the other chains kind of serve its purpose for its for their customers. And Bitcoin has the Lightning Network, so um, I don't believe all blockchains want to solve all problems, but from kind of like looking at their specialties, people are pretty comfortable making some sacrifice, but eventually I think the development of the technology will catch up, and there will be a bigger kind of multi-chain world whereby there will be the bigger kind of ledgers where they're interoperable with some of the other app chains and fit for purpose blockchains.
Okay, thanks, Michael. I guess, yeah, what's your view on that? I think maybe just given an Australian perspective, and I guess you obviously work a little bit globally as well.
Look, I think at the really, I think Glenn said it really well, so I agree with everything he said. But I think if you take a different view, that I might describe it this way, if you're talking about how is blockchain technology working and being used, never before in history have we had so much open source code written in such a composable fashion, all available for free, be published. And many people are just starting to wake up to this incredible code bank that exists in the blockchain world that's emerged over pretty much the last 5 years. Huge amounts of money have gone in, huge amounts of development on code, most of which is open source and free. And a lot of it has been focused on being composable open source free code, which is an incredibly untapped resource. It's creating raw materials for everyone to use and tools to stand on the shoulders of. So when you come to the technology itself, because all that code, of course, is native to whichever blockchain it was written for, and obviously Ethereum leads the way in those code bases with DeFi projects having been developed, you have this really fascinating resource that's built. So the question is not, is blockchain useful or how will it be deployed? It's already being deployed in places. You have the Australian Stock Exchange have their own subsidiary company running their own blockchain, because ASX has its own physical network infrastructure, which is not particularly well known, but they need it because they're a market infrastructure company. So they have to look after that kind of speed and security, which is, funnily enough, a perfect thing for being able to host a permissioned blockchain. We've seen issues with the Hertzner hosting company threatening to boot out a whole bunch of Ethereum nodes that are hosted there when the merge happens. Nearly 17% of the Ethereum network could be at risk of that happening. But you see these permission solutions coming up, say with ASX using DAML, which of course is compromises on the decentralization component of the triangle to a degree, but it's happening. The programmability of the tokens and the quote unquote money going through those systems is the secret sauce and the power. We have the Reserve Bank and the Digital Finance CRC kicking off the Australian Central Bank digital currency use case trials, and that'll go for at least a year. Don't know when it'll officially kick off, but the launch of the Digital Finance CRC was Monday night. I was surprised, even standing there in the crowd, to see the Assistant Treasurer get up and say, "I'm most excited about property tokenization to help affordability of property." Now, I think that's an amazing thing to hear from the Assistant Treasurer. A lot of people in crypto would go, okay, cool, that's what lots of people were excited about a few years ago, and then found out that the regulatory problems are difficult. But what we need is someone in government to be excited about it who might fix some of the regulatory issues. And similarly, to have Paul O'Sullivan, chair of the ANZ Bank, get up and be so incredibly supportive of the benefits of decentralization, which I don't think anyone saw coming. And I was there in the crowd with a few journalists as well, who also expressed surprise at how supportive he was. We've never seen a chairman of a bank, let alone a big four bank, get up and say, regulation is needed, but that doesn't mean central control is not going to be taken away, and effectively say that he thinks that the decentralization brings so many benefits to the operation of markets. Particularly, he was talking about carbon trading markets and the bank's view of that being a really massive opportunity with decarbonization of the economy. And the ANZ stablecoin, which viewers may recall, was just dropped without any kind of warning in March at Blockchain Week by ANZ. They just walked up and said, "Hi, we just did stablecoin transaction for $30 million, dropped the mic and walked off the stage." And everyone went, "What the hell?" And they've done further transactions since, and that is, as I understand it, going along really well. So having the movement of those major players from TradFi into the crypto space in using the technology is a huge sign of confidence in the technology. The merge obviously is going to then take care of a whole lot of the ESG arguments, although those will probably shift to say, fine, Ethereum's dropped its energy consumption 99%. It still is very inefficient and energy heavy. And we go, well, that's fine, but it's still 99% of what it once was. We don't see Bitcoin losing its proof of work status anytime soon. And so those issues will still be, will keep probably a lot of traditional businesses away from using things like Bitcoin, except perhaps for that incredible power Glenn mentioned of simply using it for that independent hashing and record of transaction to go, right, we can just use it as a stamp, an authenticity stamp. Some of the oldest hashing was done in the New York Times, where there was some funds that used to publish literally a hash in the newspaper, in the classifieds. It was just a random string of numbers. And they did that to secure their data, knowing that there were so many copies of the New York Times published, that it was a wonderful way to secure their data. And that's, very, very old school way of doing it. But even using these public chains for a limited way to give the benefits of the authenticity of data into private chains or other systems is incredibly powerful. So people are still discovering all the benefits that can come from these networks. It's going to take a huge amount of adoption to get it to a point where even bigger benefits are unlocked.
Yeah.
Simply because there's just an adoption curve that has to be followed. But in the meantime, things like NFTs in particular are driving adoption in ways that perhaps many in the space, including me, hadn't foreseen. Because turns out, the AFL selling out their NFT drop, and other people, the Australian Open Art Ball selling out in 3 minutes, and you still had to have MetaMask to get it. Just shows that people will jump over the technological hurdles if they want that product enough. And there's plenty of brands coming to the party still wanting to have more access to their customers and give their customers more ownership of the brand and be able to then figure out who their best customers are so they can serve them better. And there is an interesting schism I see of sort of, say, perhaps more libertarian countercultural members of the blockchain crypto world being like, oh, we're upset that Nike's made $100 million out of metaverse Web3 stuff. That should all be going to little startups. And others saying, well, hang on, don't you want adoption by large brands because it brings legitimacy and greater mass adoption to the technology? And we're seeing that sort of play out as these bigger players coming in, and people getting excited that Meta lets you put your NFTs in your Facebook profile, but also warning that, by the way, if you do, you're going to give Mr. Zuckerberg's business the ability to hoover up all the data to do with your wallet and all your transactions you've ever done in that wallet. So there's still interesting challenges to come, but the technology is already moving with such momentum, and so much money has been made, capital has been invested in the last 5-6 years, that this crypto winter will have far less of an effect than previous crypto winters, because the good businesses are well capitalized. They don't even care what the prices are, because their burn rates, to the extent they have them, if they're not already profitable, and many are already significantly profitable, we'll see them through. So there's too much momentum already. It's just going to carry on.
So we'll talk about the crypto winter in a little bit, and we'll talk a little bit about regulation. I think it's, so obviously you guys are quite passionate, about this particular space, and I guess it's a matter of, are you sensing the people that haven't been focusing on blockchain trusting the process, I guess, because I think that's probably the people that are keen to understand the technology and adopt. You mentioned NFTs. I've got my 18-year-old son and his friends investing until they realize they have to pay tax, so that I'm trying to educate them on that. But I guess in terms of, you kind of both alluded to it, I mean, it's probably the mainstream, it's how does blockchain get the trust of the mainstream? And we're starting to see that happening a little bit around the fringes, Mike, you mentioned about ANZ and ASX. But again, Glenn, I guess, where are you starting to see, I guess, what's the comfort level of the blockchain in Asia Pacific, and specifically in Singapore?
Yeah, so I think the crypto assets as a new asset class is already interesting enough. So we can talk about this for hours, without having to talk about, other kind of use cases more focused on the, technological aspect of blockchain. So, from, I would say, the mainstream audience, just by having another asset class that they can offer to their customers, and without having any of these crypto offerings on a level playing field, maybe 6 or 7 years ago. Now, like these companies, especially starting from the family office and the wealth managers, private banks, they are they want to be the first one to actually go to market to provide these diversified services, so that they have a new product in their truck of offerings that they want to offer to their end users, and that itself is already a huge value add for most of these traditional financial companies. So that's number one. And within the same kind of giant financial groups, there could be some other more tech-oriented divisions that are working on more of the permission blockchain use cases. So just kind of sharing informations, between their most friendly counterparts. So one large bank to the other, and then there could be security houses that are doing the sales of the products, and then the settlement houses, the custodians, and they could be a node each on this network, and then they can more efficiently share information. And whether there's an incentive structure for other players to join the gang and to add more value to this network or not, this is already kind of happening. So from a bank's perspective, you have these two angles already. One would be the crypto asset as a new kind of asset class to provide to their customer. The other one, what can they actually use from a technology perspective that will make things a lot more efficient. So these I see for sure is happening in the traditional finance market, and these large institutions are tapping into crypto natives, not just the talent, but a lot of joint ventures, a lot of investments going in, a lot of asking for advice, and I can see that Token 2049 in Singapore is coming up in about 3 weeks, and some of the largest financial institutions, sovereign funds, are actually hosting these super cool themed, like maybe a little bit degen-y, like drinks and dinner in partnership with crypto exchanges and some crypto projects. So that actually came a long way. I couldn't have imagined that maybe 3 years ago, 4 years ago when I first joined the industry. So definitely seeing the adoption there. And we don't talk about this as much as before. Supply chain use cases for the corporates, for the everyday corporates. In terms of not just sharing information, but tracking the authenticity of products, and maybe linking that in a more efficient manner and more trustless manner to build other kind of financial products around them, right? Like the account receivables and things like that. So we don't talk about that as much, but we definitely can see some of the layer ones that are more focused on these kind of use cases. So the development is definitely happening in that space. Yeah, so I think we see a lot of great things happening in this space for sure.
Yeah, and I think we'll talk regulatory in a minute, because obviously that's probably a hot topic in Australia and globally. But just a quick question in terms of Web3. And Michael, I guess maybe just a little bit of a what's your perspective of the development of Web3, and when do you think that this is going to be viable, I guess, within Australia and more globally?
Well, I think it's all about disappearing behind the UX, right? So I see in the little map you've got Ligon there, who I hold up as a great example. They're owned by a couple of banks, actually several of the big banks, and do digital bank guarantees. But their end UX interface is just log on to your internet banking, hit who you want to send a bank guarantee to. It all rolls out on a blockchain in the background. You don't need to know or care. The actual bank guarantee is tokenized, but the end user doesn't need to know, doesn't need to care. So it's the same as the internet. And that's super exciting for everyone who's involved in it, and all of us nerdy types who are going like, oh, look at all the cool things and the nodes and everything. But the regular person who just wants to buy an AFL NFT because it's cool and they want to get their player with the nice little image, and the NFT tickets rolling out now with images and art and stuff on them, the end user just doesn't care. They want the cool thing. They want the enjoyment of what the product is. So it's same as the internet. No one needs to care what TCP/IP is anymore. In the early days, people got very excited. I had to learn HTML back then, and all really nerd out on it. But no one cares, because at the end of the day, you want a website. No one peers into the code of websites unless they're in a small category. So I think that it's more about making sure the businesses trust the blockchain systems which they are deploying to do to bring these amazing offerings to their customers. And certainly, it's that, because without that benefit of what crypto assets offer and the benefits of decentralization to help reduce the friction and program where tokens can go automatically, then the alternatives are more attractive. You regularly hear, even at Monday at the DFCRC launch, there was plenty of comments to say Australia's payment system is amazing, we don't need to replace it. But then there was an interesting comment of, however, there are some interesting gaps that blockchain systems do better than centralized systems, and that's what we want to explore to see if those better things can make the system better overall. And that's the interesting jump, and that's the Web 2, Web 3 jump, right? To build something that's completely Web 3 oriented around Facebook, first of all, you have to define Web 3, and it's fairly loose at the moment. But bringing that ownership and control to customers is very complicated, with wallet hosting and whatnot, and plenty of things start out saying, yes, we'll get everybody to use their own wallets. And then the UX challenge is too hard. So suddenly it becomes, okay, great. Now we'll custody the things for them. Why? Because it's convenient for the customers. People want convenience. So there will be levels of decentralization, but there's only so many people out there who want to have full, total self-custody, self-control of everything as if it was money under their mattress at home, and as if they digitally had their giant folder of baseball cards purely under their control. A lot of people want it to be somewhere else and safe. That's why one of the reasons bank and vault providers exist. People worry about being a target of and security problems, and know that if they can outsource that risk to someone else and have someone else look after it, it's peace of mind. There's a reason that law firms have giant safes where we keep deed packets and wills, because people are afraid of it getting burned in a fire or something. So there's a lot of old school stuff that still comes back to bring that certainty. And there's large chunks of our financial system which do that now, and those same needs still need to be fulfilled. But it's about having the blockchain hidden away from the end user, except where it's necessary to be out there, where you really want someone to have their own custody. And that's always moving along and developing further. And that's the cutting edge part that's striking the right balance. But really the B2B part can be more technical, because then you can have specialists who understand that and can really bring those benefits in there. And a lot of the businesses in your map there are involved to greater or lesser extent with that B2B interfaces, where those real benefits of blockchain and self-custody and that automation can come and shine through, and they can understand it, but the end retail users fundamentally don't need to. Like if we have a CBDC, which you have to use MetaMask and understand crypto to use, it will fail, because my mum won't be able to use it. She won't understand that, and then she'll be too freaked out at having digital money on a phone, and if you lose the password, you've lost your money as if it's a note, right? It won't work. It's got to be put in a way that people find more convenient than the next alternative, which I think is going to get there. But that's where I see it sort of trending along. It's not so much trusting in the technology itself. It's trusting in the technology enough at the business level to move behind the good UX, so the customers can benefit from all the upside.
Yeah, I think it's going to be interesting to watch. I think I think you're right. There's a cohort of people that just want the ease of doing things seamlessly without thinking about some of the technology. And I think, again, it's going to be interesting to see about the adoption, I guess, of people of a certain vintage. My mother won't even SMS me the passcode to break into the house in Buffalo, New York, because she thinks someone's going to actually steal it in transmission, versus if she'd send it via blockchain, she might be happy, but she probably never heard of that. So I think it's going to be a big education piece in terms of getting people sort of comfortable with the technology. That was a good conversation. I'm going to move to regulation, because I know this is a big topic, and I know, Michael, you're very passionate about it. Sort of here in Australia, and Glenn, I want to get your views on Asia Pacific. But Mikey alluded to, I guess, government and government being supportive, and obviously the Albanese government and APAC announced a series of upcoming regulatory updates to protect consumers and investors, playing in cryptocurrency. there's a press release from the government announcing the intent to work on a token mapping exercise, and which would be the first time this has been done anywhere in the world. But Mike, maybe you can just give a bit of an overview of what exactly that means, and I guess why do you think that this is necessary?
Well, that came out of the bipartisan Senate inquiry. I think that exactly depending on how you define it, you would have some issues with perhaps defending that it's never been done anywhere in the world. The UK did it years ago. Lots of other jurisdictions have done it. In fact, the Senate recommendation was, let's go and look at all the international token mapping and analysis that's been done and adopt best practices. So we don't have the exact shape of what the token mapping will look like, but I would certainly hope it's not going to be the first time in the world that they do it, because we can build on all of the work that's been done before us and hopefully make that faster. The greatest and most certain benefit that will come out of token mapping is there will be budget and time for regulators and politicians to understand and be educated on the space. That will be the absolute minimum benefit that comes out of token mapping. On top of that, what will come out of it will depend on what is done as part of that process. If we see a process where someone tries to sit down and take a list of 20,000 tokens and analyze them and slice them up into boxes and decide what they should be, then I think there'll be very limited benefit from the exercise, because it will be outdated quickly. And if any of those projects shift, then the analysis won't be right, and you'll end up with a whole lot of time being spent that people will feel is not as optimally targeted. However, if the analysis is done following, say, the UK model, where we look at a really principled, what is this? And UK has proposed that data objects should be a new kind of property. That's quite interesting, because that then flows through definitionally into a whole lot of things that could then actually capture what's happening with the technology. So I'm a huge fan of the UK approach. I think it's very considered. It interfaces very well with what we have in Australia, being a legal system that's born from the UK legal system. So we have a lot of similarities. So my hope is that we do get to stand on the shoulders of giants there and follow their model and look at this data object idea, as well as recognizing that for the most part, tokens are just a piece of digital property, unless there's something on top of them or some other activity which requires specific regulation. It's easy to say, okay, we're here to protect consumers, but the ACCC has a mandate to prosecute misleading and deceptive conduct, and has done, as far as I'm aware, 0 prosecutions in relation to scams and misleading and deceptive conduct allegations in the crypto space in all the years that have been happening. And there's been news stories on various things and some exchanges that went under, and if people are engaging in misleading and deceptive conduct, they should face the consequences, and the regulators should move. I'm not sure that you need a whole lot of new laws if the existing ones do a good job. And we have very, very protective consumer protection laws now. And I always get a little bit annoyed when people say, oh, crypto's the Wild West. I say, no, we have laws saying you can't engage in unconscionable conduct and misleading and deceptive conduct. They just have to be enforced. And they have nothing to do with financial licensing. They are there as a consumer protection from that disclosure and representation side that doesn't need to worry about custody or what's happening with other people's money. On the licensing side, that's a different piece which we could come to. But I think certainly from the token mapping side, we should come out with some ideally good, broad, principled definitional matters which are going to help inform later regulation. But this is a marathon, not a sprint from the government. So they need to do it in a way as well that it will keep going. That it's not something which is just one government's attempt to push it through. That's why there was a bipartisan Senate inquiry. This is not a Labor or a Liberal issue. This is a technology issue. And while the Liberal Party might be expected to be a little bit more, we'll do innovation and protect consumers, and you might expect the Labor Party to be a bit more, we're going to protect consumers and also there'll be innovation. At the end of the day, it's mostly the same thing that everyone wants. And we have politicians and public servants in good faith going in there trying to strike a sensible balance. And it's obvious that things like centralized exchanges who have been asking to be licensed for years are going to get their wish. And then it's just about the detail of how that's deployed.
Okay. Now, I guess, Glenn, from a Singaporean perspective or broader Asia Pacific, maybe you can give a bit of an overview of the current regulatory thinking and some of the immediate things that are happening there.
Right. Okay. I mean, I think I can share kind of what I've seen, not really getting directly involved in, talking to the regulators or kind of working amongst the group of people that are targeting this issue. But I'd say, from a high level point of view, Singapore government has always been very open when it comes to new technology. And, with the openness, they were quick to build some guidelines. So, these are some of the things that you can do. These are some of the things that you can't do. These are some of the things that you have to put into consideration if you are offering a B2C business, B2B business, a trading business, security tokens business, which was a hot topic, maybe 2 or 3 years ago. So they actually dissected, some of the potential businesses that could come out of this new innovation. So I remember 3-4 years ago, Singapore actually got an influx of overseas talent, establishing companies, and they did spend some time with the assessment due to COVID and other things, but they did give enough opportunity through a sandbox approach to basically interact directly with the businesses that are building different type of products. Now, in Singapore, they started issuing the Payment Services Act licenses to the crypto native companies, and also some of the traditional finance companies that have established a separate business to kind of tip their feet into the ecosystem. And with that, even the public is they feel much more safe now. They've kind of built, the regulator MAS has built the credibility of the industry by taking their time, but also at the same time, building these guidelines so that some of these younger startups could follow, and not having to spend like so much time or money to trying to do this and that and not really materialize into anything. So I would give credit to the Singapore's MAS for that. I would say, because I'm Korean myself, to talk about a bit about Korea. Korea is, I think it's a little bit different. There's huge number of people that hold crypto, mostly on a retail level. And, these crypto literacy of Koreans like super high because they're pretty digital native in nature. So because of all of the existing Web2 businesses, they did the job really, really well. There's a lot of interoperability kind of built by these intermediaries. So, getting them to look at crypto and, to Michael's point, I think a lot of the crypto companies transitioning from Web2 to Web3 did a pretty good job of not really showing the difficulties of using this technology in the background. So, there is a huge number of people that are holders of crypto. Many of them are traders. So the Korean FSS, Financial Supervisory Service, I think the approach that they took was more from the retail consumer protections perspective. So their focus was more like, okay, you have massive exchanges in Korea. So you as an exchange, you have to prove to us what you're doing from a security perspective. Like, how do you custodize, and how do you operationalize these centralized pool of assets, which are in the number of billions of dollars? How do you do that? So what are some of the track record of these people running their business? What are some of the disclaimers and terms and conditions that you present to the retail customers to make sure that the retail customers know what they're getting themselves into? So, their angle was more focused on consumer protection. And from that perspective, I feel quite confident that the Korean exchanges, especially the centralized ones, have the highest level of trust from the users, almost to the equivalent level as some of the large financial institutions. But that kind of hindered from some of the more kind of like newer dApps and decentralized projects from building in Korea. So I can kind of see, as a Korean looking at how Korea crypto landscape evolved, that there is a bit of a balancing act that could have actually been considered. But like it's everything's in the hindsight, and they took I believe just looking at the demographics of the crypto users in Korea, that was probably the right way to go. Whereas in Singapore is much smaller when it comes to the number of consumers. But then, Singapore's always been an international hub, and they wanted to make the innovation happen. So they maybe have, put more of a wider kind of high-level stance, but making sure that there's enough sandbox environments for everybody to kind of like, play into.
Yeah, it's interesting. I think, so if I bring it back to my world, the accounting world, so I think one of the challenges is, I went to Malaysia, I went to Indonesia, in Australia, crypto is accounted for 3 different ways in 3 different countries. And so I guess, one of the challenges is, when will there be consistency in terms of the treatment for companies that are dealing with crypto? It's a lot easier if it's an individual person, trading in crypto. They don't really care how they're accounting for it. So to me, it's going to be interesting in terms of how we get some consistency from an accounting perspective, as well as, the regulatory environment. And Michael, you sort of referred to, we're in a marathon. I guess where are we on the marathon run, in terms of, from a regulatory perspective? Because I think we're going to need some convergence at some point in terms of regulation and accounting treatment. So are we halfway through? Have we done a 10K, or we have a long way to go before we get to the final ending place?
The challenge is with the changing nature of the industry with ongoing developments is there may never be a finish point, because just like traditional world, accounting standards are always evolving and regulation always has to change. So I would say we're more towards the start than the end, but equally the end is always going to be continuing, because it's just a constant path of how these things are done. So in terms of getting over significant hurdles to give certainty, that's probably the next biggest challenge in the next few years. And the hardest part of that is because the industry is so mobile, and regulators have probably never seen such a mobile industry, which is made up predominantly of such a young base of employees, contractors, entrepreneurs. Traditionally, that treatment and regulation can be set up to say, here's our market. If you want access to our market, play by our rules. But when it comes to the digital world, and it's not just cryptocurrencies, but the digital world more broadly, but specifically when you come to crypto assets, it's so easy for businesses to say, oh, you don't like what we're doing, or you won't give us certainty, well, we'll go somewhere that will. And we have no issues because we don't have families and mortgages and whatnot. We'll pack up and leave. And so one of the big challenges for government and regulators is to get over that hurdle and hill of striking what is here an incredibly sensitive balance, because they will simply chase away businesses to other jurisdictions, which then will defeat any consumer protection angle if it is not friendly enough for innovation. So you have certain aspects that are easy. Centralized exchanges. TradFi businesses rolling out blockchain. Yes, those are fine. Those are the easy ones. The bigger challenge is when you have the more decentralized tools and things like smart contracts. We've seen the back and forth with Tornado Cash recently, and a congressman actually just wrote to OFAC in America, I saw yesterday, basically telling OFAC they got it wrong and they shouldn't be trying to sanction code. So we're shaping up for some interesting arguments around to what extent does decentralized code even create something which can be the subject of regulation. And that harkens back to the crypto wars of the 90s, where the US, for those who might not have been around for that, the US sought to put export controls on cryptographic code, which of course a lot of developers went, this is insane, it's just code, and culminated in some amazing t-shirts that had the compression codes on them being worn around to say, well, if it's printed, it became protected speech under the First Amendment, and thus you could walk around with a t-shirt showing the compression code that was not allowed to be sent offshore out of America because it was considered a national security risk. And it showed the ridiculousness of that position that then fell away. And smart contracts fit into a similar kind of category. And in fact, that was what was being raised in this congressman's letter, saying this is decentralized code that runs by itself. How can you possibly say that it's sanctionable? And what do you say about all the problems that flow from it that I don't think OFAC is going to have any good answers for, and many people won't have good answers for. So that is a huge struggle. That part is really hard, and things like the Senate inquiry in Australia didn't try to tackle with that in any really meaningful way because it was a really hard problem. It's easier to take care of the lower hanging fruit first, but that balance to be struck is the most challenging part. But education so that regulators understand that and don't knee jerk into well, tough luck, if you don't play by our rules, you can't be here, leading to people leaving and the huge opportunity in jobs and also benefits from Australian and protection that comes from having businesses here which are playing by certain rules and meeting our norms is the really hard part. So that's the part that needs the careful running to be done for quite some time. And it's going to take a few years to get through that.
Yeah, Michael, I think it's probably fair to say only you and I remember the 1990s, but yes, it was before 2000 for those listening. So we'll switch a little bit gears into the crypto winter. I know, Michael, you kind of, you mentioned you think it's going to be short, but maybe, as the start, winter is coming, and there's been a lot of doom and gloom recently in terms of the crypto winter, but maybe you guys can just explain, what exactly that is and sort of contagion risk, if it freezes for a long time. But Glenn, maybe I'll start with you, and then Michael, I'll get your perspectives.
Right. Okay. Yeah, it is indeed a crypto winter. And I guess, one difference, between the past crypto winters to this one is that, the past 10, 13, 14 years that crypto has been around, the governments were printing money. So, we were, kind of inflating ourselves while crypto obviously, took the benefit of the macro environment. And, even though there was the crypto winter, there was, very little kind of macro resistance from the crypto prices to bounce back up. So this time I feel it's a little different now that we're challenged with a lot of the macro environment as well. So like it's very hard to tell how long this crypto winter is going to last. Whether there's going to be more bleeding from here onwards. I think it's highly correlated to the macro environments. But that being said, this is my second full kind of crypto cycle. Crypto people refer to as the 4-year cycle, the Bitcoin halving cycle. So this is actually my second crypto winter. The first one was really brutal, personally, and I didn't really know what to do because the ICO was gone, and I saw very little engagement from the main players back then, and that was pretty devastating. But now in my kind of second turn of this crypto winter, I see there's a lot of B2B investments that are coming in. And even the big guys, the mainstream, they understand that right now it could be a good time to make these investments. And I think they took the past 13, 14 years of the crypto, adoption, ever since crypto has been around, the adoption curve, the adoption cycle that starts from retail, and then now into more of the high net worth individuals, the private banks and family offices, and then to institutional B2B business. So, I can see that there's, still a lot of crypto companies are raising money, and, these big traditional institutions, including the government institutions, are, showing interest in the space. And there's actually a lot of innovations happening from, like GameFi space, from insurance space, from these decentralized, DAO, which I think is very, very interesting as well. There's the NFT hype, maybe a year ago, but just kind of being a person in the industry, how this NFT is transitioning from a hype to something that will be more longer term and, permanent. The use case of becoming, something like a membership or something that is more interoperable between like a game to e-commerce and to something else within the digital native kind of a lifestyle that younger people enjoy.
Glenn may have froze in Korea. The crypto winter has hit him. Michael, what's your view of the crypto winter?
Well, I think as I mentioned up the top, I don't think it matters. The businesses that have done well and set themselves up correctly and are now well capitalized, well funded, can ignore it. The upsides of a crypto winter, just like in the previous crypto winters, are that it shakes out projects that didn't have good fundamentals. When the tide is rising, it lifts all ships. And when it goes out, you see who wasn't wearing swimmers, is the old joke. So I think that there is contagion. We're not finished with it. I think Sam Bankman-Fried of FTX has made some comments about that. And I think that's going to take a while, could take up to a year to go through. You've got probably some zombie companies out there that have been burned on maybe Celsius or 3 Arrows, and they're still hanging on. That issue around centralized regulation of centralized entities may also shake that out a bit, because you have a strange situation where if, when funds go into many exchanges, there is very little information that you can see on the blockchain, and the benefits of blockchain cease because the centralized exchange has control of those assets. And if it's got a lot of assets being mixed in there, then there is scope for problems to happen. And we've seen that in some limited exchange collapses. Almost all the exchange collapses to date have had something go on with what is in effect client assets. And in the Cryptopia example, there are arguments and then upheld that things were held on trust, which, from a legal perspective, addresses the issue and says client assets should be kept, kept separate and kept appropriate place, safe, and not dealt with as if they're personal assets of a business. But that's been a common hallmark. I suspect there's some more of that out there. And I should say, in the Celsius example, they were very open about that. They were saying, you give us assets, you face counterparty risk, we can do what we like with them. And while they were making money from them, everything was fine. But when they weren't, in that crypto winter, so that's been the biggest impact from this crypto winter, I think, is that contagion spreading through. And fundamentally, a lot of lessons seem to be getting learned in crypto that the traditional financial markets learned many, many years ago, but these happen faster. So things like, if you're earning lots and lots of interest but exposing yourself to counterparty risk, you're getting paid interest because there's counterparty risk. But when that's mixed in with staking that's non-custodial that can give, baseline risk-free returns, things get muddied, and you need to be really across the details to know what you're getting involved in. But I think that contagion's not quite finished. And so things will move through there, but we haven't seen it go as a stack of dominoes through the industry, taking things out. But fundamentally, it's healthy in a market economy for businesses that don't have sustainable models or haven't done the right thing that way to get cleaned out from time to time and not limp along forever. It's not an effective use of capital. So, and it really hurts for those who are involved in a collapse or lose funds in it. But for the overall ecosystem, it is better that those who are actually doing the right thing and doing it well and looking after their customers are the ones who are continuing and serving customers. So I think that there'll be a net positive in the long run, but I just think that the well-run businesses won't be touched by it, which is compared to the last one where everything went a lot quieter. But a lot of people just buckle in and build and carry on. And so many, as I mentioned, whether it's individuals or businesses, have done so well in recent years that it is okay. They can happily continue on and it's not going to cause a problem. You're not seeing a flood of people back to TradFi jobs trying to find it. You're finding rather the opposite. TradFi and even the economy generally struggling to find people who want to come and work in those traditional industries. A lot of people are wanting to go into these more exciting places because they see that as a future. And there's still a shortage of people in blockchain. The fact that there's still shortages of people to be hired into these businesses is indicative of the investment that's going forward, and things like the RBA pilot moving forward. That it just shows that this is a blip. I actually personally, if I had to take a pick on the price action, I think it will continue for quite some time. I think prices shot up a lot. I think they will continue until the macro headwinds change, because there has been a lot of people treating crypto not as an inflation hedge, but treating it like a tech investment. And of course, lots of people gloating and saying, oh, look, it's not an inflation hedge. But any student of economics can tell you, well, if you have enough people coming into a market who believe a thing, the thing will be true. And prior to the big last run up, it was a lot of people saying, no, it's an inflation hedge because we believe it is, and that will make it true. But if you have a lot of people come in who go, oh, look, it's like a tech stock, I'm throwing money in the hopes of doubling my cash. All right, when it falls, they'll all head for the doors, and when inflation goes up, they'll head back to safer places because they're not diamond hands. And so then that will, there is some inflation hedge benefit to things like Bitcoin, which are there, but if they have froth on top, the froth has to go away first before you get down to that baseline. But when it comes to a sort of macro level, I think this might last 6 months, it might last a year, but I suspect there'll be some other thing that's built that's very exciting. Could actually be NFTs that are continuing to grow and grow and grow. You saw the prices jump up and go down. They, if I had to guess, would be the first thing, not necessarily price-wise. This is not people are going to be making stacks of money off very expensive JPEGs, but just the industry of products coming out as NFTs that people see inherent value in will continue to grow out in ways that we haven't seen. And that may then bring up the more quote unquote traditional crypto environments to be doing other interesting things as well. But there's so many directions in which this entire industry grows that to stay focused narrowly on, say TVL and Bitcoin price and things like that is to miss a far bigger picture.
Glenn, before you froze, you were in the middle of a great thought, I'm sure, but was there anything else you wanted to add from a contagion perspective?
Yeah, sorry about that. My MacBook just did like a scheduled reboot, so
Okay.
I'm sorry about that. So I mean, just one thing that I wanted to kind of say was that on the topic of DAOs, So, the blockchain technology actually gave a lot of the corporates, companies, or communities to actually get together as a DAO with a common goal. And, like me personally, I have a few friends in the industry that are part of DAOs. And, some of the very skilled developers, they work many jobs. They can work like 3 or 4 different jobs. And, they are incentivized using the tokens, the tokenomics, in the powered by the blockchain, technology itself. And I think that itself, similar to NFT, is a new thing. It's a new thing, but just kind of looking at how these organizations are run, it's very cost effective, and it presents a new opportunity. You can have people that are decentralized all over the world, and they are incentivized with the common goal, and that, I believe, is very powerful. So, if there's anything coming out of a bear cycle, that there will be something new that becomes more of a mainstream within the crypto industry. I think it could be the DAO. I think it could be the NFTs. I think GameFi is already happening. And the adoption is super fast in GameFi because most of the gamers are already digital native. So for them, it's very easy. And like the blockchain technology and the NFTs actually really scratched their back when they were gamers in the Web2 space. The things that they've earned by spending a lot of time and being smart on the games, they couldn't really take it with them when when the games when they no longer want to play them, or when the games discontinue. But then now, a lot of these game companies that are more service oriented, they understand exactly what these gamers want, and they know that these are more digital native, so they can make a very seamless experience, from the gamers, all the way down to maybe making some profits with some items, and then they can actually bring it out on the same platform though, seamlessly, and then they can go to 7-Eleven and shop for their wine or something. So these things are, I think, the innovations that's going to come out at the end of this crypto winter. And I don't know how long it's going to take. I also feel like the price action will be volatile for some extended period of time. But I have more conviction than ever that we are building, and the strong ones will always survive. And this is not going away.
Yeah, I think those are some great insights. I mean, it's almost Darwinism, on a cycle in terms of, and I think we're seeing that, sort of play out. I think, Michael alluded to in the old days in the financial cycle would be slower builds to a, kind of a bit of a crash. We've seen it sort of every, 10, 12 years. Obviously with crypto it's happening more frequently, but I think the strong will survive. And I think, as we come through this next period of crypto winter and contagion, as you guys highlighted, hopefully it's going to be a better end product and further enhancement that allows it to go mainstream. So that's the end of our discussion. So I wanted to just thank you both for your kind of wonderful insights into blockchain and crypto. And before we wrap up, we just want to see if there's any questions online, which I don't think that we have. So Michael, just before we wrap up, what's your prediction for the next 12 months? So when we have our next blockchain update about this time next year, where will we be sitting?
I think we will be looking hopefully at the amazing things that the RBA CBDC pilot is showing, particularly around that programmability of a CBDC. We will have the ANZ stablecoin pushing out in more use and have been piloted a number of times, if not getting deployed in a more practical way. We obviously will have had our token mapping wrap up and have some interesting learnings from that. And fingers crossed my proposed way forward rhymes with whatever comes out the end. I think we will have even more names in the cloud of logos that you had at the start, and could be twice or 3 times as big by then. We're still seeing all these Web3 funds that have been raised by VCs are out there. They're hunting. There's plenty of people looking. Investment has tightened up, but it also is a push to quality. There is so much innovative stuff coming, and so much, as I mentioned at the top, code out there that it's cheaper and faster to put something together which is innovative. And there's so many opportunities for people to sit down and analyze and try and find that value that can be added and then push it out. So, we're not going to see as many token offerings coming out in the next year. We might see higher quality ones that go there. Glenn's probably more across, raw layer one blockchains being out there. I suspect there might not be as many launches of those. So I think we'll see a lot of action in the TradFi space and centralized and permission blockchain space, but leveraging the benefits that they can out of blockchain. And some of them won't have any benefits at all, and they'll be doing it as, treating blockchain like a hot sauce just to put on a business idea to make it taste better, which doesn't always work. You've got to put hot sauce on the right things. So I think that's where we'll see things in a year from now.
Yeah, Glenn, what's your prediction for the next 12 months?
I think more Web2 companies will come into Web3. And they'll be pretty confident coming in because if they're these Web2 companies that have built a good customer base in the service that they built in the Web2 days, then they will be pretty confident migrating that kind of demand over into a Web3, creating different kind of value. So I think there will be more token offerings coming out from the existing Web2 companies rather than from the startups. So I would just end at that.
Okay. Thank you, guys. That brings us to the end of the discussion. Thank you, Glenn and Michael, for your valued insights. I'm sure everyone would find that was a great session. You'll see on our screen the details of the next few webinars that's going to be happening through 2022. And the next one will be talking about capital raising and IPOs. Obviously, the market hasn't been fantastic for capital raising, so I think that's going to be an interesting conversation with the ASX as well. The details of the webinar will be shared with you in our follow-up email from today's session. If you missed our earlier webinars, my team will be adding links to watch that. And finally, before we close the session, we'd appreciate it if you would fill out a short feedback session so we can improve on our next ones. So again, thank you for joining today. Thank you, Michael and Glenn, and hope you have a great Friday. Thank you. Bye.
Thanks so much, Tim and everyone on the video.
Bye.
Thank you.